Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this particular course, we will be discussing trading Forex. Now, there is, of course, risk inherent when deciding to trade these financial markets. So just before we do begin, please do familiarize yourself with the following disclaimer. So the topic of this particular course on demand will be, of course, trading Forex. We'll be looking at defining foreign exchange rates, obviously as the most common tradable asset class. A lot of traders look to trade the volatility of foreign exchange with the Forex pairs, given the amount of market participation and hence volume. It is the objective of financial traders to actually identify strength versus weakness. So that's what we look to do as foreign exchange traders. That and actually assessing market correlation or Forex correlation that helps us with a quest in defining those strengths and weaknesses. And then we look to define the importance of entry and exit strategy, something that is very important for any asset class that is really quite volatile. And then obviously in terms of finishing off with our discussion on trading Forex, we look to identify the most important factors or characteristics of the Forex markets themselves. So I'll wrap up the lesson nicely. Foreign exchange rates, what are they? Well, international currency exchange rates display how much one unit of a currency can be exchanged for one other. So very simple. Obviously, if you're looking to trade the euro against the dollar, it'll be representative to how much 1 euro is actually worth against the dollar. Currency exchange rates can be floating, in which case they change continually based on a multitude of factors, or they can be pegged, otherwise known as fixed, to another currency, in which case they still float, but they move in tandem with the currency to which they are pegged. Knowing the value of your home currency in relation to other foreign currencies helps investors to analyze asset prices in foreign dollars. And that's fairly logical to understand. Even if you're deciding to go on holidays, perhaps you're living in Europe and you decide to go to the United States for holiday with your family, you're going to obviously have some savings there that you're going to look to change into dollars. And you're going to be interested to understand how much that is actually going to provide you in terms of your domestic currency exchange rate to the US dollar, so that you'll know how much you'll have to spend there on your holidays. Investors who actually trade these markets do the same thing. They want to know what price they're going to get in terms of their asset class or their portfolio of investments and what that relates to in another currency. So it's totally logical that all these trades take on the same sort of logical thinking. For example, for a US investor, knowing the dollar to euro exchange rate is valuable when selecting European investments. A declining US dollar could increase the value of foreign investments, just as an increasing US dollar could hurt the value of your foreign investments. Okay, so that's again logical. If you're looking to trade US investments, of course, you're going to want to know how much that's going to cost you in terms of your euro value. It might provide you with some cheap investment opportunity, and obviously a good investment opportunity is just not as a result of the asset class or investment itself, but perhaps because of the actual dollar exchange rate. So let's define both really I suppose definitions in terms of deciding exchange rates. We have fixed exchange rates. A fixed exchange rate, sometimes called a pegged exchange rate, is a type of exchange rate regime where a currency's value is fixed against either the value of another single currency, to a basket of other currencies, or to another measure of value. Today, most fixed exchange rates are pegged to the US dollar. That is because the dollar is used for most transactions in international trade. Countries also fix their currencies to that of their most frequent trading partners. And obviously the US is a global trading partner, so it does make sense. In the past, currencies were fixed to the value of gold, and that we'll actually go on to discuss with you guys why that is the case now, why most of these currencies, majors and minors, are actually pegged to the US dollar. Really the Bretton Woods system, which we'll discuss in some detail. In contrast, a floating exchange rate is a system where the currency price is set by the free market based on supply and demand compared with other currencies. So totally free market based. This is in contrast to a fixed exchange rate, which we've just discussed, in which the government entirely or predominantly determines that rate. The currencies of most of the world's major economies were allowed to float freely following the collapse of the Bretton Woods system in 1971. So just to reiterate, really, most of the world's currencies actually float freely. We are obviously, as financial traders, we're of course of belief in free economics, free markets, and we look to trade and profit in these free markets. The world's currencies now trade to a large extent on totally free markets, allowing themselves to float freely. And this is really as a result to what was a long test in terms of the gold standard, otherwise known as the Bretton Woods system, which actually collapsed there due to economic recession in the United States in 1971. So let's discuss that in some detail. In 1944, the Bretton Woods Agreement, countries agreed to peg all currencies to the dollar. The United States agreed to redeem all dollars for gold. President Nixon took the dollar off the gold standard in 1971 to end the recession. Nevertheless, many countries kept their currencies pegged to the dollar. Okay, so that is what was very much the case in the past, pre-1971. We had a level of appreciation to domestic currency to the gold. So basically, the Federal Reserve backed its US dollar currency to its gold reserves there in Fort Knox and other places. That was equivalent to, at the time, the level of monetary policy or money supply within the economy relative to the amount of gold the US held on reserve. And obviously, the US could redeem other domestic currencies to the US dollar based on its gold. So we had Nixon then change this as a result of a deeming recession. And this is what we see really as a result of this. Just to name but a few currency pairs, both majors and minors, we see the US dollar against the South African rand, the US dollar against the Japanese yen, the Australian and the New Zealand dollar against the dollar, the Canadian dollar or loonie against the US dollar, and the Chinese yen there again against the dollar. So they're all pegged to a certain extent now and trading or floating on the free market. So let's discuss a few important factors when trading Forex pairs. The first being they're regarded as a safe haven investment, and that's just in regards of cash. You know, we often hear the expression cash is king. It's no different in terms of approaching the investment communities or potential investments. If you take a moment of financial instability, perhaps you have your money in a risky investment, or you have your money in a bank which is going through tough times, you often see people look to take out their cash because they want liquidity. So if we think to an example, again, people use the analogy of storing all their cash under their bed just for safety. That's because it's a safe haven approach. You often see the US dollar see some capital flight and the Japanese yen see some capital flight, as these are safe haven currencies during times of instability. Trading is focused on strength versus weakness of one currency to another. Certainly the case, and as we'll discuss throughout this webinar, guys, that's what we're exactly trying to do when we are trading the Forex markets. We're looking for one strong currency and potentially a weaker currency to trade that against, so it will obviously see a more explosive move in our particular favored direction. That's certainly the essence of Forex trading, strength versus weakness. The most volatile of all asset classes with constant price movement. And they have an unquantifiable amount of economic variables that formulate price discovery. So again, price movement is opportunity in financial trading. There's just no doubt about it. Now that lends itself to volatility, but if we consider a Forex pair like the euro against the US dollar, consider the amount of factors, the amount of economic factors that determine the price, just a huge amount of factors. If you were to look at perhaps a Forex calendar, you will see the crazy amount of different variables, economic data variables that will go into actually changing the price. So it does provide opportunity to trade these markets. And foreign exchange currencies always trade in pairs. So they do provide, I suppose, more structure to your trade in terms of if you're looking to just go long the US dollar. Let's say you think the US dollar is looking to increase in value or appreciate. The question isn't just to buy US dollar. It is to obviously look to trade these pairs so that you're looking for the best trading opportunities. Potentially you're looking to get long the dollar, of course, but to decipher which currency will be weaker to the dollar as opposed to others. So it has, a totally different dimension in terms of trading other asset classes. So let's take a look at how we can view this trading in financial markets. This is specifically the market watch here from our MT4 trading platform. Now what we can see is obviously the prices quoted with their bid and ask on the right hand side, and then our respective currencies on the left hand side. Forex prices are quoted in financial markets with the base currency relative to the quote currency. Again, that is simply our 1 unit of currency on the left relative to the quantity of currency on the right. Whether you're changing currency in a bank or trading currency in these financial markets, prices are quoted both to buy that currency, which is the bid, and to sell that currency, which is the ask. Okay, so that is essentially the bid and ask price. You cannot simply buy a currency at one given price. It fluctuates. If you want to become a buyer or go long, you'll be quoted one price for the currency pair. And if you're looking to sell or go short that currency, you will be quoted the ask or another price to actually take that position. The difference between the bid and ask is simply the commission or charge for the transaction. So that's simply the cost of doing business for these trades, whether you're trading in the financial markets. Or just to reiterate, or to go back to the example of a bank, when you go to look to buy some currency for perhaps a holiday or vacation, you will be quoted the bid price, of course, in exchanging your domestic currency for that foreign currency. Okay. A gain or appreciation in the Forex pair represents base currency strength versus the quote currency. This is depicted as bullish movement on the price chart. Okay, so that is what we're going to see on the price chart. Here we have the euro US dollar again. We see the euro leg is highlighted in green, and that is just representative, perhaps in this trading period. The euro is much stronger than the dollar, and we are seeing a bullish movement on the price action chart, albeit with some volatility with the wicks there to either side of the candlestick. Strength versus weakness then is in essence what we are trying to accomplish here when trading these foreign exchange pairs. Trading Forex markets is all about trying to create the most favorable setup for you as a trader. Whereas the equity markets are completely one-dimensional, meaning you can either choose to buy or sell the stock or index you believe to be strong or weak, the Forex markets offer traders a plethora of ways to trade the market. Let's take, for example, a Forex trader who believes the euro will strengthen. The choice then is to carefully choose a Forex pair which offers the best trading opportunity, i.e. one which is experiencing weakness itself across the Forex markets. So what we'll do is to look to buy the euro. Of course, we know that is a directional bias for that domestic currency, but we will specifically look for one that is weak or experiencing some weakness across the trading period, or that time that we want to trade the euro to the upside. So let's look to see how we might accomplish this. Here we have the euro US dollar price chart here. Our entry is an open. So the trader has chosen to go long the euro and bought the euro US dollar off the market open. Now, basically what that means is when the market opens, they're buying the market just off the market open. The trader has not only decided to buy the euro, but effectively decided to sell the dollar. You're effectively taking two theoretical positions here. You're looking to buy the euro, but you're looking to sell the dollar. Again, you're looking to sell the dollar against the euro and buy the euro against the dollar. So it has a different dimension to the trade. The trade then is a factor of euro strength versus dollar weakness. And in this particular trading day, the euro is actually weak in the currency markets. However, the US dollar is even weaker. So you can see that actually the trader has effectively made a correct decision in buying the euro dollar off the market open. Even though he was incorrect in his decision making, he believed in euro strength and chose the euro to trade against the dollar because he maybe did some analysis and seen dollar weakness as well. However, the euro hasn't been strong necessarily, and you can see with the candlestick, the euro upon entry on open has increased. So he's effectively made a correct decision as a result. Let's take another example here. We have the euro against the South African rand, or ZAR. The trader wants to go long the euro. His analysis tells him the South African rand is the most underperforming currency in recent trading. The trader has not only decided again to buy the euro, but effectively decided to sell the rand. Again, totally different dimension to the trading these markets in terms of strength and weakness. The trade then is a factor of euro strength versus rand weakness. And in this particular trading day, the euro is relatively strong. The rand, however, is experiencing real weakness, and we can see the absolute result of this trading decision on this analysis. We have entry on open and buying the euro ZAR off the open, and because really of the South African rand experiencing real weakness, we can see the candlestick is very strong indeed. So it's a combination of two factors: euro strength and of course rand weakness, and we almost have an engulfing Maribozu candle trading to the upside. So a very good trade in this example. Perhaps one of the most important factors to consider when trading Forex and the Forex pairs is that they share a level of correlation. Now, the most obvious factor is, of course, that all Forex pairs where the same currency is either the base or the code currency share a level of correlation. Now, why is that? Well, let's take, for example, the US dollar against the yen and the euro against the US dollar. One is obviously the base currency, the US dollar yen, and the US dollar there is the quote currency in the euro dollar. But they're obviously sharing a strong level of correlation, given the fact that if there's a huge economic figure or shock to the US dollar, they will both move in tandem to reflect that move. Those regions, in terms of international trade, who share a strong level of international trade tie, will share a closer level of currency correlation than those who do not have close trade relations. And that's simply as a result of economic business. If you just think of any of these large financial transactions that move between large equities or large businesses from potentially the euro to Switzerland and Switzerland to the euro, there's going to have a lot of business there that cause a lot of volume in terms of international trade transactions, and obviously that means exchanging the euro to the Swiss franc and then the Swiss franc back to the euro for other trade transactions. So the more business that economies actually share in terms of close trade tie, the more correlation there will be with their foreign exchange rate. Here we have some correlations with many particular markets. We have the US dollar up and gold, which is down. So that's actually a negatively correlated correlation, which we'll discuss in more detail. Then we have oil prices up and the Canadian dollar up. That's a positive correlation. So we often see as oil itself as a commodity is a huge export for Canada, and obviously leads to economic growth within the Canadian industries. And we see oil prices supporting the Canadian dollar to the upside. We have the US dollar up, and again, those currency pairs that are related to the US dollar will share that correlation. So those quoted as the currency for the quote currency will obviously experience down movement when there's appreciation in the US dollar to the upside. The Forex markets also have a strong relationship with other financial asset classes, so particularly the global equity markets and commodity markets like gold and oil. Okay, this is because there are tight relationships between global trade and risk when it comes to the Forex markets. If the stock markets move down, then the Forex pairs tend to move in various situations. We have the Australian US dollar moving down, we have New Zealand US dollar moving down, Euro yen moving down, obviously the yen as a safe haven currency. We see the US dollar, Canadian dollar move up, the euro Australian dollar move up, and the pound Australian dollar move up. So this is at times we see this correlation between the stock market and various Forex pairs there in the markets. So now that we know there is a strong level of correlation between many of the Forex pairs themselves, and obviously how they affect how the Forex pairs may have a strong correlational effect with commodity prices and equity prices, let's discuss the importance of entry and exit strategy. So a few points to make really. Given that the Forex markets are typically volatile, entry and exit strategy prevents traders getting caught up in the volatility. Timing is very important when trading Forex. And particularly when you're trading what I might say shorter time periods, like scalping strategies, timing is absolutely everything. The peak of the foreign exchange market is during the US London overlap, and that's at 2 p.m. UK time. And we often see analysts describe this as the open of really the cash open of the forex markets, given the amount of volume that enters the markets at that time. Trade timeframes can be much shorter given the market volatility, so many participants are short-term, i.e. scalpers, scalping, which is a technique to actually avail of this short-term volatility. So you can actually make profit, really not by having an overall picture of strength or weakness, but just trying to assess the candlestick structures and short bursts of movement. It's really a feeling or a sentiment-based strategy to actually pull pips out of the market, and that is effectively best applied to the forex markets given their volatility. But it is very important in terms of your timing, in terms of developing your own entry and exit strategy over the sort of medium to long term to attempt to really take away that white noise and volatility in your trading. And as a result, entry and exit strategies is just so important. So a few points then, given that the peak of volume of the forex markets is during the US London overlap and the amount of noise in the market is at a high, most short-term traders will involve themselves with volatility in this time, so around 2 p.m. their UK time. Although there is inherent risk holding positions overnight, longer-term technical traders find it ideal to place entries at the end of each day. This ensures the technical trader is trading the closed trend structure and can execute trade entry at a purely technical level. So what does that mean, and how does it really assess the importance of entry and exit strategy? Well, if we look to trade towards the close of the trading day, that's structurally important for us. Perhaps it might be 9 p.m., which would be the close of the futures market in Europe and the US. And you could argue that that is where the volume, of course, or the majority of volume leaves the markets. That is what a lot of technical traders do. They see that as a structurally important time, the close of the candlestick volume leaving in the forex markets, and then look to base their assessment off the closes of each technical candlestick. Finding an entry or exit point for your trades is the single most important skill to master, and that is certainly the case, we would argue, for technical traders to look to actually find very good entry or exit points, because the markets are very volatile indeed, these forex markets. So let's assess the importance of entry and exit strategy here. And what I've done is just to choose a market where we're seeing a lot of volatility, we're seeing a lot of trading to the upside, we're also seeing a lot of trading to the downside, and some of it is very quick in terms of trading up and reversing. And I've actually used these arrows here, both bullish arrows and bearish arrows within the price chart, to dictate that and to show you guys. So I've actually chosen a potential trading opportunity. Entry strategy will help traders avoid the white noise and look for the best potential trades here. So let's just assess this potential trading opportunity. Again, we've seen a lot of bearish and bullish movement both to the upside and downside. Obviously, that would allow scalpers to involve themselves in this opportunity, but it's something obviously quite difficult to do more consistently. Perhaps the idea would be to look for a more structured opportunity. So we see more of a bullish trend to the upside, and we can see then with this volatility that this could perhaps reverse. Of course, we've seen then here that we had a little bit of a price structure after an engulfing bearish candle to the downside. We can see that the price structure breaks at this level, and then there's continued momentum to the downside. So just potentially one idea you could potentially implement into your entry strategy to look for a more consistent structure, perhaps just for one trade-off, as opposed to trying to involve yourself in this volatility and white noise in the markets. So you can see there is a lot of trading opportunity looking across these forex pairs. Just by looking at the volatility, you can see there are some good trades out there in the short term as well as the long term. What I'd like to do is just to discuss some of the most important characteristics of the forex markets. Why do we trade the forex markets with so much activity? We know that they're the most popular of asset classes, but why do we trade them with so much activity? Volatility is opportunity in financial trading. Okay, we know that and we accept it. We accept these risks. Forex markets are the perfect markets for those who like to trade the news. We know that, as we discussed, they have an unquantifiable amount of variables that can move price, and the movement of price provides us with that opportunity. So we often get a lot of traders who actually like to look at Forex Factory or some of these Forex calendars and simply trade news, looking for quick bursts of price action to look for some pips out there in the markets. They are the most liquid of all asset classes and therefore offer best price execution. And that is certainly the case across all these platforms. You'll see the cost of doing business, or the spread, is the most tightest in the Forex markets, particularly if I can quote perhaps the Euro US dollar, the cable market, something like the Euro Australian dollar market. All of these Forex pairs generally have a 3 pip spread, which is very, very affordable for many traders. They offer a plethora of ways to make profit, and that's absolutely the case. They are not simply one-dimensional. They share different dimensions in their trading approach. I did show there one example during the webinar that one trader had decided to buy the euro, and it wasn't a particularly strong day for the euro, but there was at this particular trading time there was some weakness in the US dollar, and that actually, even though his overall trade decision or idea was incorrect in looking for euro strength, because the dollar weakness actually caused that market to move up to the upside, he actually made profit during that trade. So there is a different dimension to trade these Forex pairs. And correlations provide insight for other trading opportunities. So whether you're looking to trade perhaps the gold market or the oil market, you will look to see where the US dollar or the Canadian dollar is trading to see if it's strong at that time. If you're looking to trade perhaps the Japanese yen, we'll look at how the stock markets are trading. So there's many different insights that can provide good trading opportunities for you as a Forex trader. So let's have a review of the webinar. Obviously, look, they're very popular, they're very common to trade, but that's because they offer a lot of these Forex pairs offer a lot of good trading opportunity. We discussed the foreign exchange rates and how they actually now have moved on from the Bretton Woods system in terms of free floating exchange rates. We looked at the Forex pairs, and really the essence is to trade strength versus weakness. As you get better at identifying these strength and weakness approaches, or to what causes strength or what causes weakness in a currency, you will become better Forex traders. We looked at Forex correlation and really how important that is, and then assessed potentially trying to assess entry and exit strategy as really defining an edge as a Forex trader, as opposed to just getting involved all the time with the short-term volatility and scalping. And then, just to summarize, we discussed the important characteristics of those Forex markets. The volatility is opportunity, and they provide fantastic insight to many other markets. So that does conclude our topic on trading Forex. All that's left for me to do is thank you very much for joining us. We do hope to see you very soon, and bye for now.